Hello, everybody. Welcome back to Crypto Talks. My name is Phil. That's Rob. And we're doing Macro Tuesday for the first time this year, 2024. Yay, right?
Yay.
Yay. Now, this is going to be pretty wide because we're going to look at basically just a quick overview of the macro perspective right now. We're going to look at global liquidity, for example. We're going to look at actually, Rob, you know exactly what we're going to look at.
We're going to look at stuff. We're going to look at basically where the market is currently at, where it's likely to head. Basically, we've done these sort of macro reviews every now and then over last year, and it's been a few months. So I figured this is a good way to kick off. Is just an overlook of basically where we are is something that I think people want to know, and it gives us a chance to look at it as well, because we don't spend all day every day looking at these things, because they're very long term. These are very long term patterns, and they take months to show up. So we don't look at them very often. So it's nice to have a bit of a review and see, like, the markets will always kind of cry strength or cry devastation.
It's nothing. There's never anything in between. There's always one group screaming, "Oh my God, we're gonna die," and another group screaming, "Yay, bottom's in," and whatever.
And if you look at the kind of the macro perspective that we've outlaid continuously over the last year, then has it improved? If it wasn't for the fact that the stock market was going up and Bitcoin's going up, which there's literally a name for it. It's called the wealth effect, where people feel richer because on paper they are richer. Their assets are worth more. But if you don't realize those assets, are you actually richer? Because those gains can fade pretty quickly in a lot of cases, and people will think and feel richer. They'll go out and spend money. They'll take on debt, and then the market turns and they're stuck with a lot less money than they thought they had, with a lot more debt than they planned on having, because of course in their mind the bull market was forever and this is it now, 10 years worth of money. And maybe that's the case, but let's just have a look and see.
Perfect. So first of all, hi Dylan. It's going really well.
Hello.
Thank you. How are you? Now we're gonna jump straight into this. What I'm thinking is, since we did we did TA Monday yesterday, because obviously it was Monday, and we kind of looked at where we think things might go and so on and so forth. So I just want to jump back into just really briefly on Bitcoin and see where we think stuff might go, price might go, and then we're going to roll that into the whole macro perspective, and that will clear out a lot of kind of, if we think the macro market is gonna overall just kind of keep falling down, or maybe we're close to a fall and we're seeing Bitcoin kind of sitting on support right now, it will clear up some things for a lot of people. So I just want to jump right back into this real quick. I'm not gonna sit here and look at the Bitcoin price much, but here we go. This is our chart. If you've been here before, you recognize this as usual. And so what we had very recently was this little dumpily dump right here. And we've broken through two very significant trend lines. I don't know why that's there. And we have a fib level right here. We predicted yesterday that we might be bouncing here, but we also said that there's a chance that we are going to 32K. That is in case the macro tells us that, okay, we're going to have a period of, downtrending overall, right? And that's when I can see Bitcoin going to 32K. So that's just a I can't even talk today. Reiteration. Okay, keep in mind, everybody, I'm Swedish, yeah? I'm allowed to make weird mistakes in my pronunciations.
Don't
but
worry,
okay.
bro. You speak English better than me, fam.
Yeah, sure. So what I want to start with is what's the overall market sentiment right now, just in kind of the short term, because we're going to look at the fear and greed. And the fear and greed tends to kind of swing with the pumps and dumps of Bitcoin. And right now, here's the fear and greed. It's currently at dead center at 50. People are extremely neutral still, which means the trend is still intact, whereas everybody's still fairly bullish, but now people are kind of waiting. So when we get stuck on neutral for too long, I tend to see the overall sentiment on Twitter and all that go kind of negative over time. So if we stay here for too long, we might start seeing it rolling down. And if we keep falling down in price, just, kind of slowly down towards that 38K or 37K to the fib level, then I think we might see that fear and greed index kind of fall further down to fear, right? Which is yay for us because we have dry powder to buy more, right? I hope you've taken our lessons or our thinking into mind when you gather up your cash to buy more, buy the dip and all that. But yes, so fear and greed is actually dead center right now. And beyond that, I think you had our old favorite chart up, right, Rob? In regards to where interest rates and everything is going.
Yeah.
And if you followed us before, everybody, I'll just say you will know that we have a specific chart that Rob is about to show that we were living on that for during the big downtrend in 2022 and the beginning of 2023. So I'll share that right now, Rob.
Before I do show it though, can I just get the fear and greed back up?
Yes, and, you can.
Could you and scroll down to the chart for it and
yes,
view the all-time, go on max.
Max, there we go.
So there we go. Yeah, the thing to it is, it's one exercise you can do is you can actually if you take a screenshot of this, you could go to TradingView and actually put this as the background on the chart, and you can actually see how this layers against price, and you'll see very, very well it does correspond well to peaks and troughs. And you will also see it's not perfect because of course it's just a sentiment chart, it varies, but overall we can quite clearly see over the last year, 18 months, there has been a bottom in sentiment and then an increase of higher highs and higher lows in sentiment. And that's very clear that we have an uptrend. There's an uptrend in sentiment overall, and that means that even the dumps are people don't wait around anywhere near as long. And if you think about it logically, right now with everything that's happening, the fact that Bitcoin is now 20% down from its all-time high, we have said, if there is the likelihood of a deeper correction and it comes down to somewhere like 32K, and in that case, we'd probably see the fear and greed index come down to, I'd say, somewhere around 30, somewhere that makes a larger macro, a macro higher low, but it's still a deep extreme drop into fear, when actually the price is still 100% higher than it was at the bottom, say. So we can really just think about it as a it's this, if we have a period where we sort of bottom around here, this sort of 50-ish on the fear and greed, then consider that actually this dump might not go down as far as we want it to. And so you can look at these big picture sentiments, and this is a macro picture. This is the picture of how the people are reacting to the market, and people are, as you can see, very, very predictable. And the people are in an uptrend right now. Their sentiment is heading upwards towards crypto. Rightly so. It's a very, very bullish thing. There's an awful lot of growth potential in the market, and we had 2022, which is quite frankly disgusting. So it's sensible that don't sit on your hands too long. Don't be absolutely tied to this idea that we're going down to this certain price. If you had, I don't know, not everybody has obviously this much to allocate, but say you had $5,000 to allocate, consider keeping, say, $2,500 is for that 32K. And on the meantime, you allocate on these shorter term drops. But then if we don't reach 32 and the sentiment bottoms and starts to head upwards, then you look at it and go, okay, it's 36, 37K. Even so, in a bull market, if you sold anywhere at 43, 44, or you avoided buying up at those highs, then when you see the sentiment's bottomed, the trend has shifted, because even though we looked at the short-term weekly, weekly, it looks like it's very, it's oversold, it's rolling over, and although that could lead into a multi-month or a year-long downtrend, it could also just be a blip, and it could just roll straight back up and carry on being bullish. And we've seen the weekly come out of overbought and back into overbought multiple times. And it's don't be too greedy for a drop. Greed works, but greed works both ways, both up and down.
I mean, and yes, and we do have arguments, and we're going to get to that because Dylan just asked, and I've saved that comment just so I don't forget. But we do have arguments for both a 32K drop and for a kind of stopping out here at 38, I would say. And we will finish the stream by looking back at the charts and kind of showing you where our levels are, because I saw that you were talking about 33K and ours is at 32, and I'll give you an argument for 32 specifically by showing the charts. But yes, Rob, should I show yours your little chart that we like so much?
Go for it. So so this is the chart of truth. This is the US economy in a nutshell. And so for people who've watched the channel for a long time, they'll know what it is. This is the federal funds rate in white, basically the interest rate set by the US government, and the squiggly varying curves in different colors, those are bond yields. So these are the interest rates of different duration bonds. And so we've seen this 40-year, this is a 4-decade long downtrend of interest rates, going from the high interest rates, which peaked when the baby boomers entered the workforce and reached the peak of their spending power, and then they've degraded considerably as birth rates have dropped, the number of people entering the workforce have dropped, and the amount of money that's been needed to be added to the system has gone down. And that's all. All inflation really is the price paid for goods and services. If you've got a very, very, very high demand for goods and services, the price of them will go up. It will go up, and you need more currency to satisfy that growth. And we've had this period where we've had interest rates dropping and dropping and dropping at the same time that the amount of currency has been going up and up and up and up over years. And part of that is necessary. That's Keynesian economics is not just this method of printing money into infinity to destroy your purchasing power and enslave you. It's simply a theory which states that if you grow as the economy grows, then the amount of currency that supports it should be elastic and grow with it. And interest rates are simply a method of getting that money out into the market. Now, we then decided to completely bastardize that approach by creating quantitative easing, because we have digital money now where we can just create it magically out of thin air. Normal money creation is it's interest rates, because the interest that gets paid on a debt, as the debt gets paid down, the debt is eradicated, that money disappears, but the interest that was paid on the debt remains, and that is new money. And so the amount of money that we've been creating has been dropping for years and years. And now suddenly we've spiked interest rates at a period of time where we have a huge amount of government debt. And so now this interest rate, this is new money. This is being added to the supply. The holders of that debt are now getting richer. So, richer in fiat terms. So as this carries on, as this continues, this is basically what QE, this is QE. This is money being added to the system, and this will in turn drive asset prices higher. This is how healthy economies are supposed to work. Unfortunately, economies that have the debt burden that many of our many advanced nations have, is this is unsustainable, and eventually these things have to drop. Now, this chart I'll just switch onto now. So this is the yield curve, the entire yield curve. So basically, this is the interest payments on different duration bonds, going from the shortest one, I think, is like 6 months here or 1 year, all the way up to 30 years. And it shows you the curve now and versus 1 month ago and 6 months ago. Now, what we're seeing over time is that now the interest paid on these long-term debts is a lot higher now in the blue line than it was even a month ago and 6 months ago. This means that the government has now taken out more debt at high interest rates for long-term durations, and so this is permanently applying a long-term increase to the debt burden of the United States, because this is the interest payment that they have to pay on it. And the longer this goes on, and the more interest that they have to pay, if the economy continues to slow down, which it has to do if you've got a heavily debt-laden economy and you have high interest rates, because what do people have to do? They have to pay money to service that interest rate, and that interest rate has to, that loss of profit has to come out of it has to. There's nowhere, where else does it come from? So unless you're going to offset that by growth, you're always going to have a hit to the economy of this. And so as this high interest rate environment continues, this yield curve scenario gets worse. The amount of interest that is piled onto longer term debt means that this debt burden gets worse for the government for years and years and years. What's the solution? Oh, you have to wind back interest rates.
Mm-hmm.
So we know that these interest rates are unsustainable. We know that cheaper money it has to come, but we don't know when. And we also know that cheaper interest rates are very unpopular, because we know that will cause spikes in inflation. And we have inflation we can take a look at that, is coming down still. I know in the UK, how are we looking in the US, Phil?
Let me really quickly check, because I didn't save that on on this particular window.
It's a problem that's going to get worse over time, and so the longer it goes on, the more the incentive to lower interest rates are. The really big incentive. Go on, then you can flip it on. So the really big incentive is if something breaks. So
need to just move it to the right window. Give me a sec. Okay, here we go. So here's I just grabbed the Truflation site. It's faster for me to find. But essentially, the aggregated inflation rate in the US is 22%. The current inflation rate is according to Truflation 1.82%, and the US government reports 3.4%. Which one to believe? I don't know. I tend to not trust governments that much. However, the government numbers are usually the one that actually matters, even if this is true.
But either way, regardless of the numbers and how true it is, the chart is telling the truth here. Inflation is coming down. It's just broken down to a new low. We're at a 1 year low here, and that we shouldn't expect, while we have such high interest rates, this is going to continue. And as bad as it can be in the US, that's not a bad thing. But in other nations, if they get pushed into deflation, this is a death spiral for many economies. So, and again, the only way out of the death spiral is for the USA to print money, because we have to remember the USA is not the central bank to the USA; it's the central bank to the world. And if the world needs liquidity, this is the Fed's job to provide it. They say their mandate is only to the US. But
they know that's bullshit.
They know that's bullshit. Yeah, and the United States interests are served by keeping the economies that make all the stuff they consume, and as the largest consumer nation on the planet, if these economies fail, the US gets hit incredibly hard because they suddenly have to pay a lot more for the same goods and services that they previously have received at incredibly cheap prices, because this situation will necessitate the US government easing. And so you can see the state of this, and then at the same time we're talking about doom and gloom, it seems so far, but the S&P 500 nicely broke out to all-time highs this week. So great. We're at all-time highs. Does it feel like an all-time high? Does it feel like we're off to a new bull market? I'm not so sure
like
about
it yet.
It really doesn't feel like it. And I'd just like to point out, maybe we know that Bitcoin acts a little bit faster than other than traditional asset classes. But if we hide this and then just put the Bitcoin chart up, then does this look familiar?
Yeah.
Does that have we seen that? Does this look like anything that's happening right now? And we had that joke that beat an all-time high in a bear market.
You know what you could do, by the way, now that I think of it, if you want to, before you close the S&P down completely, open it against the M2 money supply, since we were talking about inflation, and I did mention that in the comments here on the side.
So for anybody wanting to know how to do that, so you just go to whatever you're looking at and then divide it by M2SL, and that gives you
M2SL.
Yeah. So we have definitely, we've definitely broken out of what is actually a very, very long lasting range going back. Basically, we've made a 23-year high on the S&P in the last few weeks.
Yeah, in purchasing power.
And so are we entering a .com bubble? No. Who knows? I don't see how or why it would go that far. That seems a little bit excessive. But it's this is a very clear breakout of even the immediacy of this trend line is going back to 2020. So this is this is a 5-year breakout. This is a big deal, and the question is why are things going up so much? And it's what I think, or what I'm seeing is there's a lot of sort of bad data that's a lot of obfuscated stuff happening with the economy. And going back to the yield curve, the yield curve is the chart of truth, because what you can see is it tells you what's happening with how people are looking at US debt relative to what the government says this is what we want debt to be at. Because you see short-term debt, here are these purple ones, are very short-term durations. They are the 1 year and the 3 month. They follow the Fed funds rate very closely. Because they have close expiries. So whatever the Fed funds rate is, that's what this debt is issued at. The longer term debt takes a lot longer to actually change. It will follow the Fed funds rate, but it will follow it much more slowly. So you have the 5-year here in blue and the 10-year here in orange. And what we're seeing here is when we have these pauses in the Fed funds rate. So we had this pause here in 2006, and we had this pause here in 99, and you can quite clearly see we're looking at having a pause now. So what has happened during all these pauses is the longer term interest rates, these long-term bonds, have started to head down, even as the interest rates have held. And in the dot-com bubble, it's clearer. Interest rates said, nope, I don't care what the Fed funds rate is. This debt isn't worth holding at these prices. This is risky money, is what he's basically saying. And we're anticipating, we think that there's going to be a crash and interest rates are going to go down. In the housing bubble, not so much until they did start to go down. But then you see, the drop was very, very fast in bonds. There was a very rapid purchase of bonds as people went, housing's crashing, I'm going to buy the US government debt. Now, the longer term bonds haven't reached the Fed funds rate. They're looking at it and saying, we don't anticipate US growth to be anywhere near what you're saying we're going to pay you the interest rate as. And that's what you've got to think, that's what bonds are. They're an anticipation of US growth, because for the US to maintain and pay that debt at 5%, they either need to print money or they need to grow enough to pay that amount of money. They need to raise taxes by that amount. And if you're anticipating that they can't afford to pay that growth and they're going to have to print money, well, then why would you buy bonds? Because that printing money devalues the bond. So the long-term yields will give you a clue as to what the market really thinks about the claims about the US interest rates. And it says interest rates are too high. It's it's screaming out there on this chart that interest rates are too high and they're not sustainable. And yet you can go back as many times as you want. So here's, let's say, similar behavior. And I guess the 70s was a bit of a different time, but even so, during this period where interest rates was as high as 19%, but bonds, nope, 14, 15, we're not offering any more than that.
No.
So, yeah, that's an overlook as to how bonds are looking.
Can I just real quickly, before you leave that, I actually realized I opened my Fed funds chart, which I haven't looked at for ages, and I think you remember me doing this. Remember?
Yeah.
It was our prediction to how long the pause will be, and I think we had an average of these two here, and we averaged it out to this. Everything is an average of these two together, and currently it's playing out. Obviously, there's a long time left before it actually plays out, but I'm going to keep this here, and I think it's going to be fun to look at this every quarter and see if it actually holds up. So we're basically halfway through the pause right now, according to this prediction. And we're really, the orange line right here, I don't know if you can see it, but that's the Bitcoin halving, approximately. And I think it's going to be fun to see if this actually plays out, because if it does, I'm going to put myself on a pedestal and say that I am a god tier analyst. Not really, but this will be fun to see how this plays out.
Yep, for sure.
I pressed something. Big face Phil. Ew.
Giant Phil.
Giant Phil. Not what you want on your plate.
Yeah. No. So overall, the market is signaling that your 5% is too high. 5% interest rates are not sustainable, and that's I think one thing that's going to certainly exacerbate that is the current the current geopolitical situation, the current wars either kicking off or being threatened across the world. The perfect example being what's happening in Yemen with the Houthis is that regardless of any political stance on the matter, that the insurance for shipping through this strait has gone up by a factor of 5 or 10, and it's added a huge amount to the costs to transport cargo through one of the busiest shipping lanes in the world. And I saw someone today talking about the Houthis and going, your Amazon stuff's not getting delivered, and so you think that's okay to kill innocent people. And it's like, that is a gross oversimplification of what is a complete and total blockade, essentially, of global trade, which costs the economy a huge amount, which will stall growth, which will these aren't these are just economic realities. There's no politics involved. If this happens, then this happens. And if you have these military conflicts brewing across the world, then we know governments can't afford to pay for them because they're all running deficits. We know they can't afford to pay the interest on the debt that they have at the moment. What is the play to get out of this predicament? Drop interest rates back to zero, money printer go brr, and there would be an awful lot of assets go up. There'll be an awful lot of inflation, but there'll be an awful lot of onshoring, and the US economy would probably enjoy a manufacturing boom, as everything would get a lot more expensive, but as a result, it would be economical to produce in these countries again. So that would create a huge amount of employment, and there are hidden benefits across to economic events, and these macroeconomic events cause huge shifts, and they're going to have both good effects and an awful lot of bad effects. But yeah, we're going to see where it's going. But overall, the look isn't good.
Yeah.
And so just a couple of quick charts just to show. I had we had the S&P up here, so I just want to add Bitcoin to the equation. I'm just going to put the normal S&P back on. We just want to add Bitcoin to the equation and go, we can see where the peaks line up, but this becomes a lot more stark when I put this on, which is the Global Liquidity Index.
Yep.
And you can see very, very clearly, even as far back as 2017 and even going back to 2014, global liquidity rising, Bitcoin went up. No, flat global liquidity, Bitcoin no go up. Increasing global liquidity, Bitcoin go up. No increasing, Bitcoin don't go up. So yeah, and we've had a massive drop off of Bitcoin liquidity, and yet, even though we're making lower lows on liquidity, we're making higher highs in price. And this is where you see the asymmetric side of Bitcoin coming through, where we can say Bitcoin was massively hit by the liquidity crunch but that was in 2022. Bitcoin bottomed out, it lost 70% of its value. That's played out now. That doesn't matter. We've reset. Now is the new fundamental bull market, and you can see that if the S&P's gone absolutely batshit over a relatively short amount of liquidity increase. Now, either this is a huge overbought fake out, and demons will await below, or the market is starting to price in a reversal of this liquidity, and it knows liquidity is coming and it's getting in front of it. So
markets are front running. Sure.
Markets are very, and Bitcoin is very front running, because there's a good example of this. If I take off the S&P, is just to look at Bitcoin, and before the liquidity index peaked, Bitcoin had already peaked and had been falling for 4 months. And yes, the CME futures played a part in that, but it didn't create the entire bear market. And
no, for sure not.
That was that was liquidity. It was the markets cooling off. Even as much as here is these bubbles. This is a clear proxy for global liquidity. You can see the peaks exact, and we don't tend to think of Bitcoin being a institutional asset in 2014, but well, look at it. Yeah. So we should expect this trend to continue and get stronger. But we also see that when Bitcoin has had its dump, it tends to start doing its own thing. It will move up. So we can see very clearly where the previous halvings were, and they will, the halving will play a part, because above all else, it's a fundamental event that has market implications. And so it's like just putting them on, and it just so happens to be that all of the previous halvings have coincided with big pumps in liquidity. So maybe the halving is completely meaningless, and that's also always something to consider.
Yeah, maybe imagine that if the entire Bitcoin community has mistook the Bitcoin halving for the pumps in liquidity, in global liquidity, just because they happen to coincide. That would be hilarious to me. Let's ask Saifedean Ammous.
Yeah, and I'm definitely in that camp. I think because since the last halving, and particularly at higher prices, the amount and high volumes, the amount of Bitcoin and crypto in general accumulated by exchanges just through trading fees exceeds the amount of Bitcoin accumulated by miners, meaning that the exchanges are more important in terms of sell pressure than miners. And exchanges operate just exactly the same as miners. They don't sell their crypto they sell the crypto they need to at the lows in order to, because they want to hoard it. They save it during the bear market, and then they dump on you during the bull market, and then they make all their funds, and ideally that gives them the revenue to keep going for 4 more years until the next bout of liquidity comes through. So yeah, I think it's the only way to it that the soft landing narrative is coming through, and the only way the soft landing happens is if the numbers are massaged by whacking interest rates down, growing the economy hot, and dealing with the inflation consequences, and just blaming them on the war. That will be it. We can't do it. Wartime economy.
Yeah.
And to an extent, the public might accept that if it's seen as a just war. Unfortunately, that's not necessarily the case, and the PR campaign has to be managed very carefully in that sense, because piling on a lot more debt onto this economy is not going to be popular. But
right.
Unfortunately, it's a complete and total necessity that either asset prices go down or the amount of currency units supporting those assets goes up. That's it. There's no alternative. Right now, there's an asymmetry between the two. This chart, the S&P, the SPX versus divided by money supply, shows it. But you cannot have this is basically coming out to all-time highs versus the money supply. 20-year highs versus the money supply. This is not where the stock market is supposed to be, and so it either needs more money. Oil prices have to come down, in my opinion.
And something that I really like about this chart as well is that it really shows you that it's pretty much pointless to save money in the S&P, because I don't know if you can see the percentage gain there in terms of purchasing power, but you can see the chart, right?
Well,
I mean, it's basically sideways for many years.
Yeah. Well, okay, this is on the log scale, so we'll just... Oh, hang on, that made no difference. Why did that make no difference?
I don't know. It's okay. We need to move on anyway. So
yeah,
I was gonna say, since we were talking about exchanges, I did pull up the Bitcoin on exchanges, the balance, from CoinGlass, and at the bottom here you can see there's about 1.9 million Bitcoins on exchanges right now. In the past 30 days, there's been 80,000 added, and I think a lot of that has to do with, or at least some of it has to do with, and actually, you know what? I'm not sure if Coinbase, since they're holding the ETFs, most of them, if that counts as being on exchanges. I don't think it does, because they're not for sale on the market.
No, because I would say that if they would be held in Coinbase custody, which are basically they're custodial wallets, but they are private wallets. So no, I don't think they would be counted.
Yeah, no, precisely. So either way, I checked this last week. It was 1.9 million. It's still 1.9 million. Not much has changed. I mean, 27-day change. 2,000. That's it. But we don't see a lot of changes yet. So we'll see what happens after the halving, I guess, with that. If it starts dropping fast, then okay, cool. Maybe the halving has more effect than we thought. But I do want to look at real quick the where is it? We wanted to look at the MBRV score and the Rodel ratio on the net unrealized profits and the PUL multiple, just to round this all off before we go into explaining why we think where our supports are. Let's see. I'll answer this question right away, actually. Doesn't the halving cause a supply shock, hence the price action? Yes. However, you have to keep in mind that even if there's very little Bitcoins on exchanges and very little new Bitcoins being created, it's very easy for people who want to take profit to just move their Bitcoins onto exchanges and sell them anyway. So the liquid supply is still large, right? So the liquid supply of people that are willing to sell is basically still the same. The more the price goes up, the more people are willing to sell, right? So what the halving does is, yes, it causes a supply shock. I mean, at least technically, the argument for that is sound. However, I don't know how much significance it actually holds in terms of price action. And yes, it will have an impact. I just think a lot of people, and this is my opinion, I think this is Rob's opinion as well, that it's a bit overplayed. Can
I weigh in? Can I just
yes
just swap onto my chart for a sec?
Yes.
So these are the HODL waves. So these, can you just hide Dylan's? There we go. So this basically shows on this very delightful chart the length of time that Bitcoin has been held in particular wallets. So yeah, you can see these purple charts, this purple area. These are basically Genesis wallets. These are Bitcoin that have never ever been moved because they appeared in 2019 as being held for over 10 years. And then so you can see a lot of these coins where they started to originate from, and there are still people who have never held their coins. And when you see these larger cohorts at the top, when you see them growing, those are your signs of accumulation. So if I look at the 1 to 2 year, when these cohort is growing, these are your short-term accumulation. This is the people who are wanting to they're buying, and then when you see them sell it, so when you see them sell, those were the traders that were trying to trade the cycle. But then the people that are holding 2 to 3 years, similarly, when you see them growing and when you see them going, when reducing, this is when it's clear signs of people selling off the Bitcoin, and these are hundreds of thousands of Bitcoin. So yes, the supply shock is in place, but the supply shock is now a case of going from 900 Bitcoin a day to 450 Bitcoin a day. So the amount of new Bitcoin in circulation is basically irrelevant next to these people. The fact that you've got these holders in place who routinely hold for 2 or 3 years, that sucking of Bitcoin off the market as they accumulate en masse, that drives the price higher because that's the supply shock. It's people accumulating. Now, when we went from 50 Bitcoin per block to 25 Bitcoin per block, now that was a supply shock. That was a gigantic reduction in the amount of Bitcoin that was available. We're now going from
1.83% inflation to 0.84, I think.
Yes. So we're going down from 6.25, is it, to 3.25? 6.5 to 3.25.
6.5 to 3. No, wait. Isn't it
6.25 to 3.12? Oh, is it 12 and a half? No. 50 to 25. 25 to 12 and a half. 12 and a half to 6 and a half was the third halving. 6.25 was the third halving, yeah. So we were now going from 6.25 to 3.125 per block.
Yes.
Yeah.
Yes.
So that is a reduction, of 450 Bitcoin a day. Now, if the ETF demand is more than 450 Bitcoin a day, and that's fresh demand, well, then the Bitcoin price is irrelevant. The miners are irrelevant because the ETF demand is just sucking that straight off the market anyway.
And that's where you get the supply shock. I guess that's where
the supply shock. Yeah. So ultimately, it's all about the supply shock is nothing without the demand to meet it, and it just so happens that the demand comes from increased liquidity and the fact that Bitcoin becomes cheap. People don't want to buy when it's 500% up. They want to buy it when it's 80% down. And So we will continue to see high volatility in Bitcoin because, as we mentioned yesterday, now that the ETF's launched, we've got an absolute gigantic, a huge quantity of liquidity available to invest in this market that previously wasn't available. And
it's also there to help us dump.
it is, well, it's absolutely. We explain that as well. It works both ways, but it's, that liquidity is, we are the equivalent of a shitcoin now. We're just a stock. Yes, we're a large stock, but if you look at the volatility of companies like Nvidia can move 20% in a day or 10% in a day in big moves. Yes, it's less frequent. Now, Bitcoin has the added ability of being cross-traded 24/7 across the globe, which puts institutions at a disadvantage to day trade it. You can't day trade Bitcoin using these tools because you can wake up in the morning and you've lost 10%. So they are just going to be used as vacuums to just suck Bitcoin off the market slowly. And so, that's where the supply shock comes from. It has to come from demand. And we're going to see these, we're going to see these waves of supply shock and then, demand shock. Demand shock is basically, that happens when all the supply comes in and there's not enough money chasing it. So, it works both ways.
Right. Anyway, we need to start rounding this off. I was hoping to round this off before 9 my time, because I have stuff to do. So we will have to kind of look at the. Actually, I'll do this super quickly. I'll have to skip the. Let's see. Here we go. Whoops, that is an extremely weird looking chart. Right. Here we go. So our arguments for 32K or why we think 32 is the level. It's because of this fib level right here and this support level right here, because it lines up perfectly here as well. And that's where we think it might have to go if it breaks this fib level right here. That's the argument. Really quick and simple. But yes, I do really need to round off now though. Yes. All right. Well, so everybody who's watching, join the Discord, leave a like, subscribe, all that stuff. You know how it works. And we'll see you in Discord because we're always there. Come hang out with us. We do this after hours. All right. Cool. Cheers. Bye.
Bye.